Good morning. Welcome to Trading Hour. It's a brand new week of Trading Hour. I'm Reema Tendulkar. With me is Hormuz Fatakia. And all the attention appears to be diverted on the weather updates, the monsoon situation, and whether your area is waterlogged or no, because the markets per se are very, very quiet. Thanda, as you call it, after last week's, gains. Even Friday was actually a fairly quiet session, and nothing sort of a session. But there's so much happening on individual stocks. So pull up a Titan Industries. That's a stock which was under pressure on Thursday, Friday, and even today. It's down close to about 4%. Disappointing Q1 update. The stock is down nearly 9% in the last 5 trading sessions, 5 days of losses. But that's being offset by strength in FMCG. The FMCG index is up 1.3%. In fact, if you pull up the Nifty, the top 4 gainers are all the FMCG names. So it starts with Tata Consumer, 2.3% up. Then you've got a Nestle, HUL, ITC, and that doesn't even cover Dabur and Marico, where there are news updates, a pickup in growth, rural, and plus with the monsoon situation now improving, that further bodes well for rural consumption. PSU banks, though, are under pressure. The Nifty PSU banking index is down close to about 0.7%. Disappointing business updates coming in from Bank of Baroda, Union Bank. Since the focus is going to be on so many stocks, I thought we'll quickly pull up the cues for this week. In terms of results, on Thursday, you've got TCS. On Friday, you've got HCL Tech. And then on Saturday, you've got Avenue Supermarts. There will also be one eye on the India macro updates. So inflation, IIP and RBI's forex reserves. And globally, there are 2 key events to watch. One is the US inflation data. And second, Fed Chief Jerome Powell will be speaking both on 9th and on 10th. On 10th, he's actually expected to deliver a fairly long speech. So we'll watch for that too.
All of last week, we were dominated by 2 stocks and 1 theme. Reliance was one, HDFC Bank was the other, and IT was the theme that dominated. But today, it possibly felt as though this is going to continue with the IT earnings and all of that. But the FMCG stocks have certainly sprung up a surprise, especially Marico and Dabur, considering the positive commentary that has come in with regards to the rural growth and in rural consumption as well. And pull up the PSU stocks, and these are the ones that have done extremely well this morning. An IRFC and an RVNL, the railway-related stocks are doing extremely well today. IRFC hit a new record high in today's trading session. 204 was the high there that it made. It's now another 7% higher there. RVNL also, there was a block deal as well that took place in RVNL, almost around 800 crores. And 550 there on RVNL as well. Ircon doing well for itself, 5.5% higher. And pull up a HUDCO. That is the stock that I wanted to speak about, because there is an initiation of coverage by Nirmal Bang on the stock, projecting a price target of 375, and in the last 12 months, HUDCO is up almost 500%. So it's the kind of frenzied moves that we have seen in all of these PSUs. The PSE index, though, is still not managing to cross the high that it made on the 3rd of June, which was 11,353. Even today's high is somewhere close to around 11,150. I say 11,160 is around 11,200 is the high of the day, but it's still not managing to get there.
The high is 11,230.
That was today's high is 11,200, but yesterday's high, the June 3rd high, is 11,353. So it's yet to get to that level.
200 points away.
200 points away, yes. It's still to recover from the losses that it made on the 4th of June. But there are plenty of other stocks in focus as well, most of them being power utilities. And they are in focus on the back of positive notes coming in from brokerage firm Investec. And Vivek is joining in with these details. Vivek, what is Investec saying on all of these power utility stocks?
Well, that's right. So, a very interesting note coming in from Investec today. So, what they've done is they've initiated coverage on the entire power space. So, both utilities as well as companies that provide EPC services, focus towards power companies. So, what they've done is, number one, they're talking about the power sector itself and what kind of demand trends they see. They're expecting demand to remain strong, especially from FY24 to FY32. See demand growth rate at a CAGR of 6.2%. What are the key drivers? Rising urbanization, increased usage of AC amongst rising temperatures, and also enhanced manufacturing as well as economic activity that the country is seeing overall. So now what they're saying is that by FY30, in addition to what is already existing, India is trying to add close to 286 gigawatts of new capacity. We are talking about power capacity. And Ministry of Power plans to add almost 50 to 55 gigawatt of new thermal capacity by FY32. Remember, this is in addition to the 20 gigawatts which is already under construction. So significant addition seen, both thermal as well as renewables. So what are the stocks that they like? They like stocks especially from the renewable space. So NHPC is one that they like. They have a target price of 124 rupees on the share. They are seeing capacity of the company to increase to 14.2 gigawatt by FY27, and they are seeing the regulated equity of the company rise to 32,810 crore in FY27 versus just around 15,000 crore at the end of FY24. The second stock on the radar, Inox Wind, similar to what other brokerages are saying, they have a buy rating there. They are saying that India plans to go ahead and increase wind capacity additions quite significantly. They are saying that they are expecting the company to register 76% and 74% CAGR respectively in revenue as well as EBITDA till FY27. The third stock on the radar, now coming to the EPC side, Kalpataru Power, they have a target price of 1,473. They are saying it's a prominent EPC player with strong presence in both domestic as well as international market. They expect EBITDA and PAT to grow at 23 and 33% CAGR respectively between FY24 to FY27. A similar mode of business, KEC International is the other stock that they like. They're saying prominent player as far as the T&D is concerned in the power space. They're saying recovery in T&D space and promising bid pipeline should actually drive revenue growth for the company at 13% CAGR till FY27. So they have a target price of almost 1,002. This is giving the company a 22 times price to earnings ratio for the FY27 consolidated EPS. Lastly, JSW Energy, while they like the stock and the company, they have a hold rating. They believe valuation at current levels limits most of the upside, and most of the positives are priced in at the current price.
Thank you very much for that. DOMS, the stationery maker, is up 4.5% after Axis Security initiates coverage with a buy rating. Why do they like it? Upasana joins in with the details. Upasana.
Axis Securities has initiated coverage on DOMS Industries. It says that Indian stationery and art material market has seen continued growth over the years, and it is expected to grow at a 13% CAGR over FY23 to FY28. DOMS Industries has emerged as a leading player in the Indian stationery market, holding an overall market share of 12% in FY23. It expects companies' EBITDA margin to be in the range of 17 to 18% for FY25 to FY27, driven by various factors such as increased capacity utilization, improved product mix, stable raw material prices, and improving on-ground execution. In terms of ROC, the brokerage says that it is likely to improve from 22% in FY24 to 25% in FY27. It also expects a robust revenue CAGR of 25%, EBITDA CAGR of 26%, and PAT CAGR of 28% over FY24 to FY27. It also says that with improved visibility in earnings growth and a strong return profile, the stock appears attractive in the mid-cap space. Hence, the brokerage initiates coverage on this stock with a target price of 2,670 per share.
Upasana, thanks a lot for that. What a mover DOMS has been as well this year. The stock is slightly off the highs of the day today, but still 3% higher. 23.15 is DOMS Industries. But if you pull up a year-to-date chart, the stock is up 85%. That's the kind of moves that you're seeing in this stationery manufacturer as well. So good going for DOMS Industries, and Axis Securities there has initiated coverage on the stock. But time for a short break here on Trading Hour. Up next to discuss what's buzzing in the commodity space with Manisha Gupta. Also get you a rain update as well. Stay tuned. Back on the other side. Welcome back. And rains have been the buzzword this morning, especially in Mumbai, and as heavy rains have lashed across several parts of the city, and most of them are now reeling under several severe waterlogging situations now. The BMC has declared a holiday for all the government and private schools in the city. My colleague Santya joins in with the details.
Heavy rain started lashing Mumbai and nearby region last night. At present, we are in Mumbai's western suburb area. This is Santa Cruz area, and the flyover above us, that is Wakola flyover. And let me show you around. So this particular patch, this area below Wakola flyover, you can see how badly it is waterlogged. You can see that auto rickshaw, and you can imagine the intensity of waterlogging. The traffic movement on this particular patch has just resumed. It was halted, it was suspended for over 2 hours. Heavy rainfall started last night. Keeping that in mind, BMC has declared a holiday for all the schools, BMC schools, private schools, all the other government schools. The heavy rainfall that started yesterday has led to waterlogging in multiple areas. This is Wakola area, Santa Cruz area of Mumbai, western suburb, and many more areas of the city are looking exactly like this. Andheri subway, Gandhi circle, Science circle, Govandi, Bhandup, all these areas are reporting heavy waterlogging. As far as the train services are concerned, Central line fast trains are suspended because the water level is above the track level in areas like Bhandup and Nahor. Slow trains on the Central line are running, but they are running 30 to 40 minutes behind schedule. Western Railway has claimed that the trains are running only 10 minutes late in the Dadar Mahim patch, Dadar Bandra patch. But as of now, train services are also impacted in Mumbai. As far as the traffic situation is concerned, the entire Western Express freeway is badly jammed, and there are terrible traffic jam patches in eastern suburbs as well. IMD has issued a nowcast warning under orange category for the next couple of hours. Next update will come soon. But as of now, IMD's 24-hour forecast was also quite off the mark. It did not indicate that Mumbai was likely to witness this level of heavy rainfall.
Santya, thank you very much for that. And I think she had also updated us that high tide is at almost 2 o'clock, 1:57 p.m. So, you know, if the rain intensity picks up post-noon, then perhaps it could exacerbate the waterlogging situation right now. But let's move on to the commodity space. Manisha is joining in, and she's got her eye on crude. Manisha, the whole of last week we were talking about rising crude prices. What's happening today?
Well, we have seen some profit taking finally come in for this segment. For the last 4 weeks, actually, the crude oil prices have posted positive gains. But this week it started slightly on a weaker note. There has been some profit taking after that huge run up that we saw in crude oil prices. And the markets will want to watch for further positive data before you can see another leg of gains come in here. But at this point in time, it's trading 0.5% on the lower side there. Well, the prices did gain 4.5% in the previous week and 5% for the month of June as well. The US non-farm payroll data came in better than street expectation. But as far as the US unemployment data comes, that's at a 2.5-year highs. You also have seen the ISM manufacturing data slightly on the weaker side. So markets are reading this mixed numbers. Other thing is that the 9-month-old Israel and Gaza war is still on, but there are some ceasefire conversations that really seem to be picking up right now. And there is Iran, Iraq, Nigeria now mediating as well, including Egypt also. So the markets do believe that since the Middle East totally seems to be working on this, that premium seems to be getting off the markets right now. Having said that, remember the hurricane season in the Atlantic has just about begun, and the first named hurricane, which is Beryl, is making a landfall tonight, and many terminals and ports in Texas are shut because of that. So oil facilities also seem to be looking at some supply disruptions. That is something that will keep the prices supported in days to come.
Indeed, Manisha, thanks a lot for that update. And Cyclone Beryl is the one that you'll have to watch out for when it comes to oil prices, as well as it strikes the coast of Texas later in the day. But time for a short break here on Trading Hour. Up next, we discuss market technicals. Vishal Malkan of Malkan's View joins us on the other side along with his top trading bets as well.
Welcome back. The big news of Friday was Bajaj Auto launching the world's first CNG bike called Freedom 125. The starting price will be very competitive, 95,000 rupees. Now, Rajiv Bajaj said they're looking to break even with the motorcycles within this fiscal year itself. Listen in.
If CNG catches on the way we are hoping it would be not beyond this financial year that we would be able to hit our capacity, which by that time could well be 40,000 motorcycles a month. And I would certainly expect that at that level, it should be as profitable as any other motorcycle we make. We are starting, as Rakesh mentioned, with 10,000, very quickly hopefully move to 20, eventually to 40, by which time we would hopefully be in some of our overseas markets as well. I can say that for this capacity, it would certainly be a figure that is more likely to be in double digits in terms of hundreds of crores. So in double digits rather than in triple digits. With the electric vehicle, for example, just to contrast, it's a very long road. You know, we've come a long way since when we started 5 years back, and now we have some line of sight to profitability. I would still say it may be a year or two away till we have reasonable, acceptable profitability with electric vehicles. As opposed to that, where we are still bleeding, and I mean the scooter. You know, the three-wheeler is very, very profitable, the electric three-wheeler. The scooter is not yet. With the Freedom, there is no bleed at all. So we start off on a very good wicket. With the electric Chetak, with every vehicle, we are putting some money on the vehicle and giving it away. Here it is not the case.
Well, the brokerage verdict on this is fairly mixed. So you've got a Nuvama, which has raised the target price on Bajaj Auto all the way to 12,000. You also have Jefferies, which has raised the target price to 11,640. So significant upside from current levels. But on the downside, you've got UBS, and their target price is down to 6,250. And the key reason why UBS is so bearish on Bajaj Auto, more than a 30% downside, is because they believe the future is EV and not CNG. So that's on Bajaj Auto. Did well on Friday, the stock, but today it's a modest downtake of about 0.5%. But moving on, Nuvama has written a note on what on this CNG bike from Bajaj Auto, what they could mean for the city gas distribution companies. And I think Sonal joins in for more on that. Sonal, on this, they've also raised the target price on an IGL, MGL?
Well, yes, they have. We were highlighting it on Friday that MGL could be in focus on because of this Bajaj Auto CNG bike launch that has come by, because it opens up a new area or a new segment for CNG companies, because it's starting, at the start, it'll be in Maharashtra itself. But now Nuvama says that they expect CNG total cost of ownership to be 29 to 32% less than petrol, 28 to 30% less than EVs, and will add around 5 to 13% in terms of CNG volumes by 2030 as well. While the initial sales focus will be in Maharashtra and Gujarat, the company is planning to make it pan-India as well by October 2024. That means the other players will get a chance as well. Management expects total market at around 6 lakh units, with CNG availability at 60%. CNG volumes could see a spike in volumes because of two reasons. First, Bajaj Auto will also launch it in new variants, the 100cc and 110cc variants, and the other two-wheeler OEMs will also look at the CNG segment, so there could be launches by other brands as well. They've raised the target price for all the three stocks from 9 to 17%. They are incorporating higher CNG volumes for FY26. They have a buy rating on the three stocks, and the target price will come up for you on the screen. So quite bullish on the volume growth perspectives going forward because of this CNG bike launch.
Stepping on the gas is Nuvama. Sonal, thanks a lot for that update. But staying with auto, but moving on to Tata Motors then, which is in focus on the back of the JLR business update. Sonia is here with more details. Sonia, how does the update look like?
It was a decent update coming in from Jaguar Land Rover in the first quarter. So if you look at the overall numbers, right, it's a growth of around 5% that JLR wholesale sales have seen. But if you look at the retail data, retail sales are up about 9% on a year-on-year basis, coming in at 111,000 units. Now, if you look at it apart from the China JV, ex of the China JV, the retail growth was actually pretty healthy for Jaguar Land Rover at about 15%. And some of their new launches have done very well. They have upped their production targets as well. So if you look at what brokerages are saying, JP Morgan has an overweight on Tata Motors. They have a target price of 1,115 rupees. Macquarie has an outperform with a target price of 1,171. Macquarie says that the product mix is something that continues to surprise positively, and most geographies are picking up now into double-digit growth, so that's something that they like as well. Addition to this is the fact that the balance sheet of Tata Motors, the group, is improving substantially, and they are all set to meet their EBIT margin targets for FY25 and 26. Back to you.
Thank you very much for that. Shilpa, Medicare, remember the conference call was today at 11 o'clock to give you an update regarding the CDMO arrangement which the company announced on I think Friday when the stock had rallied close to about 14-15%. And I'm just reading Ekta's note. It's for oxylanthanum carbonate, OLC, which is a new chemical entity molecule, and some updates related to that. Vishal Malkan is also now with us for a quick technical check on the markets. Vishal, quietish sort of a day, but in the red now, down about 20 points, 50 points on the Nifty. Your thoughts on the day so far and your stock calls?
Hi, I think Nifty and Bank Nifty, after a stupendous rally post-election, we are taking just like a halt and consolidating between that range of 24,100 and 24,300, 400. So it's nothing much to worry, but just like a kind of a consolidation on Nifty, Bank Nifty. And I think the stock specific move which we are looking at right now is, of course, the pharma stocks and the auto stocks, which are the current buzz. So I'll go with the Glenmark Pharma with a buy. With a stop of 1320 for a target of 1420 and 1450 in the next few trading session. And another stock on the auto sector would be Atul Auto, which has given a good breakout above that 790 levels. So I'll go with a buy on that with a stop of 785 for targets of 820 and 830 in the next few trading sessions.
I think on the PSUs, Vishal, a lot of them are been hitting newer highs. IRFC, IRCON, HUDCO, all of them. Anything that looks attractive to you on the charts?
I think IRFC is one thing which I'm looking at as a potential buy, and that could go another 15 to like another 10 to 15% on the upside. So that's my best bet in that sector.
All right, Vishal, thanks a lot for joining in, sharing with us your views on the index and on specific stocks as well. Time for a short break. Up next, we get you more stocks that are buzzing: Titan, Marico, Bank of Baroda, EU Small Finance Bank. We'll tell you why all of these are in focus in today's session. Stay tuned. Back on the other side. Back with us here on Trading Hour, and plenty of business updates were reported on Friday and across the weekend, and let's focus on some of them. First up, Dabur and Titan. Mangalam is joining in with details from this FMCG space. Mangalam, how has the commentary been like?
Well, commentary has been weak for Titan, and for Dabur it's been good. So that's why Titan is the top Nifty loser. So let's start with Titan itself. You know, the overall revenue growth for the company this time around, the jewelry business, which is the mainstay in India, grew at around 8%, which is much lower than what someone like a Kalyan did, you know, which was close to around 29% in the India business itself, around 28% on the overall business. Akshay Tritiya for Titan, even though it saw double-digit sales growth, remember the buyer growth this time around was in low single digits, and that's because of higher gold prices, lower number of wedding days, and weak sentiment that impacted demand. Add to that, the demand for plain gold jewelry was much higher than studded growth. So studded was moderately lower in comparison, and that would have a bearing on the company's margins itself. What did not do too well for them was the other sectors as well, which were expected to lead growth this time around. Case in point, something like an eye care or emerging businesses, which have the sari business, the Nehra, that is, and Carrot Lane as well, grew at just around 18% versus its last 4 or 5 year CAGR of upwards of 40% itself. So all these factors, with competition doing higher and the company trading at higher valuations than competition, saw a decline in the stock price today, and a lot of brokerage EPS cuts as well. The management had told us that they don't see margins in the jewelry business growing in the medium term beyond 12% as well, putting an upside cap to that as well. Let's talk about Dabur now. Dabur was good update. Why is that? Because remember, the stock did well, ever since the company reported their fourth quarter numbers, and the management here on CNBC-TV18 indicated they're gunning for double-digit revenue growth this year, led by high single-digit volume growth. And that time as well, we had seen that sequentially there would be improvement in rural demand, and that's exactly what the company has said. In this quarter, the revenue growth could be seen in the mid to high single-digit mark, in which in India there would be mid-single-digit volume growth. Remember, volume growth typically picks up in the second half of this year, so the start has been good. Home and personal care as well as healthcare segments have done well, high single digits, whereas the segments that did not do too well were the ones which were outdoor facing, and as a result of the high heat that was there during the summer quarter, we saw some weakness there. Badshah Masala for the company continued to do well, volume growth in high teens, so that's a positive factor as well. To add to all of this, the operating profit for the company has been higher than revenues. That means there is margin improvement. So good revenue growth, good margin improvement, and prospects of better second half is something that is keeping that stock afloat up today, 4%.
A quick word on Marico. Even for Marico, we should expect some margin expansion, right?
That's correct. So Marico and Dabur not too different from each other. Both of them have seen sequential uptick in demand. The only reason why Marico as a stock is moving higher than Dabur today is because over the last 1 month or so, Marico has been an underperformer, was down about 2% in the last 1 month, adjusted for today's gains as well. But Dabur had seen a big up move already. Marico posted modest uptick in underlying volume growth. It was led by coconut, parachute coconut oil, which showed about 1% sort of volume growth, 1-2% low single digits, that is. Saffola did well. That has recovered from negative volume to about positive volume. The part of the business that hasn't done well is value-added hair oils, which the company believes will get into positive volume terrain over the next couple of quarters or so. So that should be taken positively. Add to all of this, they believe that going forward, realizations and volumes will only pick up. So that would boost their performance in the remainder of this year, along with improvement in margins, which this company also saw the same as Dabur.
Indeed. Mangalam, thanks a lot for all of these updates there. Marico also doing well in today's session, up over 5%. But moving on to the banking sector now, Bank of Baroda and AU Small Finance Bank also posted their first quarter business updates. Abhishek is here to give us the details. Abhishek.
Well, to begin with Bank of Baroda, on a sequential basis, if you take a look, deposit and advances growth are the weakest in last 12 quarters. And they have lost market share as well because their YOY numbers are below the industry level growth. So take a look at the deposit momentum. It's up 8.8% YOY and a decline of 1.6% sequentially. Industry-wide, deposit growth in June was around 12% level. Domestic deposit is further weak. It's grown by only 5.3% YOY and down by 2% sequentially. The advances growth are about 8% YOY when compared to industry growth of 15-16% on a YOY basis as of Q1 that the banking sector has seen, and it's declined by 1.7% sequentially. In this, the domestic growth is about 8.5% YOY and down by 1.8% sequentially. In the domestic loan book, the retail portfolio grew really strong at 20.9% YOY and about 3.5% sequentially. So overall, the CD ratio has declined both YOY and quarter-on-quarter, and the domestic CD ratio, however, has improved YOY and quarter-on-quarter due to the decline in deposits. AU Small Finance Bank now, deposit growth is weak over here. Deposits have declined on a sequential basis. However, cost of funds have improved for them for the first time in many quarters. So deposits are down 0.5% quarter-on-quarter. We cannot compare the YOY numbers because there is a merger that's based into effect with respect to AU Small Finance Bank in this quarter. Cost of funds have declined by 7 basis points sequentially to 7.03% when compared to 7.1% in the previous quarter. Overall, AUM growth is at 3.5% while the advances growth is a strong 5% growth. So if you take a look, calculate the CD ratio, that's on the higher side at 93% plus, so which leaves analysts with the worry that there will be further hike or growth for deposits, which can put pressure on the net interest margin. CASA is up 2.7% quarter-on-quarter, and CASA ratio has improved to 33% versus 32% in the previous quarter. Back to you.
Thank you very much for that. By the way, Reliance Industries has started its up move. Remember, it was the big mover on Friday towards the end in the last 1 hour. It added on nearly 2.5%, and Reliance Industries is now up 0.7%, and that's helping the Nifty recover. The Nifty had gone down to levels of 24,250, and now it's trying to climb back towards 24,300. That up move is coinciding with Reliance, but because other than that, most of the large caps are largely unchanged. Get into a break. On the other side, we'll discuss market fundamentals, the macro setup with Manish Dangi of Mosaic Asset Management. Stay tuned. Welcome back. For macros and markets, we have with us Manish Dangi from Mosaic Asset Management joining us on the show now. Manish, morning. This is Reema here. Wanted to first get your assessment on the US economy. The latest jobs report seems to suggest an increase in the unemployment rate, a decline in job creation. So it does appear the US economy is finally showing signs of, cooling off after being red hot for so long, much longer than what, people were anticipating. So your assessment of the US economy right now, and what does this latest jobs data suggest in terms of what the Fed might do?
Hey, Rima. So you're right. Of course, the employment sort of weakness come in somewhat late, in a sense. You're starting to see some slack there. The old numbers are getting revised downward. In general, most of the nowcast in terms of growth is sort of hinting at a possibility of slowdown. I still think that markets are too perky and sort of too confident of good second half. So it's very, very likely that US lows, what Citi put out yesterday, that there could be over next 8 meetings, 25 basis point each rate cuts. And I've been of this view for sort of fairly long that, you will have US rates in threes, actually, a three handle, three quarter, three half in 2025. I think, markets are sort of underappreciating the undercurrent of slowdown in the US. So, I mean, I agree that you would have significant slowdown in US over the next 6 to 12 months, and you'll have significantly lower interest rates in US than what markets are baking in right now.
Manish, good morning. Thank you for joining in. It's more of a catch-22, right, for the Fed, because this data is coming right on the back of Jerome Powell saying last week that they would still want some more data because they're still not confident enough to cut rates. Is it so that the Fed is starting to fall behind the curve, because there are central banks that have started to cut interest rates already? And assume the fact that there is a macro data that comes in next month, which is contrary to what the street is anticipating. Does that put all of these estimates out of the window again?
So it's been sort of hot and cold. You saw 3 months of inflation, actually, data surprising on the higher side. And we had this conversation many times that, would that suggest that near 70s like perk up in inflation on cards? And I argued against it. I think in US, more than what Fed Powell spoke last time, one is, of course, politics there. If both House and the presidential seat were to go to Republicans, it's likely, and markets are worried of the fact that, you could very well have sort of more perky fiscal, already sort of bloaty fiscal or public debt that US has, it could get worse. You also have, other hints coming in from the fact that copper is perky, the crude has actually risen again. All of this is actually unnerving bond markets, So even while you see clearer signs of disinflation and, more importantly, growth slowing, copper, crude, politics, all are actually confusing bond markets, and which is why, bonds haven't really rallied. So it's this whole macro cycle, Chief, over the last couple of years has actually played very, very uniquely and distinct from what we all are sort of are used to seeing. But big picture, slower growth, lower inflation, and Fed cutting rates, that seems to be sort of the game in town, at least for next 1.5 years.
Since you spoke about bond markets, last week was that watershed event for the Indian bond markets. We've been discussing this. India finally got added in the JPM bond index. What have been the inflows so far? We've discussed the potential inflows over the next 10 months, but so far, any anecdotal evidence of what we've seen already? And now for the FPIs, there's really an attractive option, Indian equities versus the Indian debt market. What has been the feedback from FIIs, the foreign investors, on the attractiveness of Indian equity versus Indian debt now?
So sort of we've discussed this many times. Indian bonds actually are better currency play. Yeah. There are sort of great amount of tailwinds. It's very likely over a longer period, rates would head significantly lower. Inflation differential between India and Western world has actually collapsed. As we speak, core inflation is in India is could very well be lower than US's. So in some sense, what played out in China over the last 10, 12 years could play out, and I think smart money would bet on this trade. I've argued on your show that how in the next cyclical downturn that you will have over the next 2-3 years, Indian bonds would get to a 5 handle, not maybe exactly 5.5%. So there is a significant, space for bonds to rally in India. how much money, sort of a lot of money, of course, has come in. First time on a 12-month run rate basis, you have sort of significantly more money coming in bonds. Equities have been investors have deserted, and you haven't seen much money coming in there. So I still think that the game has just begun. I think, from a broad asset allocation point of view, for the given currency and where bonds are valued in India, you still have a tailwind for next many years. I wouldn't be surprised if this number of total money flow in India would run into, $50-100 billion over next 5-6 years.
Interesting. Manish, let us assume that the Fed does bite the bullet eventually and starts cutting rates in September. Now, the probability of that, if I'm correct, is now around 72% for a rate cut in September. What does that do to sentiment across the market? Because the US market itself has been a significant outperformer already this year, particularly the S&P and the NASDAQ. Does that also now cause a shift in flows back to the US once the Fed starts cutting rates? Or do you see that the EMs would continue to get flows, considering the fact that barring India, most of the other EMs have not done too well?
So in US, basically what has done well, of course, since October is mostly IT and communication. And that part of the market, of course, had a cyclical downturn in 2022 and 23. So it's a sort of a recovery. As we said, this macro setup has been messy. Different sectors have been slowing and then re-accelerating. So the tech and communication piece, if you were to see in US, is actually seeing a recovery of sort. Very, very slowish one. Still no employment growth there. Yet, productivity has risen, and overall earnings have been sort of pretty decent. So, because these are high duration assets, tech and communication, you also tend to have lower rates actually helping them. So the internals of US markets are very different than that of US, that of India. India, small and mid caps have done remarkably well, are more expensive, whereas in US, they're actually much cheaper than, even from a historical standpoint, much, much cheaper than large caps there. There, the industrials, discretionaries haven't done well. In India, just the reverse, real estate, discretionary, and all sorts of hyper-local assets and economic assets have actually, or shares have done well. So from a market standpoint, I guess the current momentum suggests that it's baking in some bit of a recovery in IT and communication in US, along with, of course, lower rates, and which basically would continue to play out. The hardcore economic sectors there, the materials, metals, industrials, and all of them, are not doing well, and I don't think they will do any well over the next 6-12 months.
Manish, thank you very much for joining in. Need to get into that break, but on the other side, we'll discuss the Indian technology space with Rakesh Kumar from BNP Paribas.
It's QSQT time, and Rima is here to tell us how the IT sector is likely to perform this quarter. Rima.
Thanks so much for that. I think the big question we're asking right now is, are we at the end of the earnings downgrade cycle? Now, the Indian IT companies have gone through a rough patch over the last 2 quarters, particularly in Q4. This is the UBS table, and you will see earnings estimates were brought down as much as 15% for companies like Infosys and even for Wipro. So if estimates have been adequately cut over the last 2 quarters, is there more room for downgrades, or are we at the end of the earnings downgrade cycle? Now let's get to this quarter's expectation. Well, this quarter we're expecting a pickup in growth rates led by 3 factors. 1, seasonal strength. 2, ramp up of large deals, and 3, reducing intensity of cuts in discretionary programs. So this is what the CNBC-TV18 poll throws up. Infosys is likely to lead with a 2.5% revenue growth, followed by TCS, Wipro flat, but HCL Tech is likely to report a revenue decline. Now, the reason why Infy is going to report the highest growth amongst the Tier 1 IT companies is due to the ramp up of previously won deals. For TCS, it will be the ramp up of the BSNL deal, and Wipro, where the street has turned incrementally more bullish, with the new CEO, Srinivas Palya, coming on board, after 5 quarters of a revenue decline, this time the street is expecting flat growth. But for HCL Tech, revenues are going to get compressed because of a large project which was offshored, and the company had guided about this in the prior quarter, so a decline of about 2%. Now, FY25 guidance is likely to be retained. So, in-fee top-line growth, 1 to 3%, margins maintained, HCL Tech at 3 to 5%. Top-line growth. CLSA believes a stable guidance is a positive. For Wipro, the next quarter's guidance is seen at 0 to 2%. For Wipro, remember, it's a next quarter's guidance and not an annual guidance. Now, brokerages have been fairly mixed on IT. Nomura recently turned positive on the sector. There was a double upgrade by CLSA on Wipro, which lifted the stock. But CLSA is cautiously optimistic on the IT sector. They say that we still largely remain in an earnings downgrade cycle, though we are getting into a more stable positive narrative, which is why they're cautiously optimistic. Jefferies, UBS prefer to be selective because of rich valuations. Now, what are the risks? One, the run-up in stocks. The Nifty IT index itself is up close to about 10% in the last 1 month, with individual names rallying about 15% plus. Two, no immediate demand recovery. There are sectors like BFSI, retail, telecom, which still continue to remain stressed. Growth expectations have been pushed forward. And finally, premium valuation. CLSA says the Nifty IT is trading at a 30% premium versus an average of 20%, implying limited room for multiples to re-rate sharply from here on.
Rima, thanks a lot for that. Let's pose all of these questions to Kumar Rakesh of BNP Paribas, who's joining in. Rakesh, good morning. Thank you for joining in. Which side of the camp are you in? There is always almost consensus that growth will still take a while to recover. But do you see that this downgrade cycle that has been on is finally coming to an end, or do you see some further downticks before a floor is hit eventually?
Hi, good morning. So from the camp perspective, for the last 1.5 years, we have been quite counter consensus positive stance on the IT sector. Late 2022 is when we turned quite optimistic on the sector, and there were multiple reasons at different stages. The reasons have been different. But we, as Rima was talking about, and you also noted, we don't think we have reached the stage where we could start calling out there is an earnings upgrade to start happening for the sector. And we think the first leg of the stock performance will actually be driven by valuation. And within valuation, it will largely be driven by the sector weight across investors moving up. If you look at the holding of IT sector, both by foreign institutional investors and domestic, it's in multi-year, possibly more than a decade low that we are looking at. Among FIs, it has fallen to about 8.5% of their holding. Long-term average has been about 12.5%. Similar is the case with the domestic institutional investors as well. It's close to about 8.5% for them as well. So there is a significant bearishness for the sector, which is built into the sector positioning across both sides of investors. And that, as the incremental confidence starts building in that the outlook is incrementally improving and not necessarily further deteriorating, this weight will start moving up. Because if you look at the weight, what exactly it is telling you, it's telling that the outlook is going to further deteriorate, and that's why there's a significant underweight positioning in the sector. And hence, even a neutral or normal outlook would be good enough for the sector weight to start moving up. And that would be the first driver for the sector stocks to start moving up. The second leg, which we think will start playing out possibly later this year, early next calendar year, is when the Fed starts cutting rate and the sentiment among enterprises starts changing. And that is when we would expect that the earnings upgrade cycle will start playing out, and that will be much more sustainable. And going into next year, we would start seeing the earnings upgrade driving the sector performance.
Just a quick word on the annual guidance. Do you also expect this quarter guidance should be maintained? And do you think at least at some point, maybe in the second half of the year, there is scope for an earnings, for an annual upgrade to, say 1 to 3% for Infosys or, 3 to 5% by HCL Tech? Can the full year guidance be upgraded?
Good morning, Rima. So for the quarter, we don't think there has materially changed from last quarter to this quarter for companies to start changing their full year guidance as yet. But as you pointed out, there is definitely a potential that some of the companies could raise their guidance as we move through this year. And what could be the catalyst for that? If you look at the CEO confidence surveys in the US, there's something remarkable which is showing up in those surveys. the overall confidence of CEOs over the last couple of quarters has been consistently going up, both on the overall business as well as their own revenue and sales outlook. So they are generally turning more positive about how their business is going to do in the next 6 to 9 months. But the same survey, when looked at from the capex spending perspective, has largely been flattish or maybe coming down. So there is a gap which is building up in the CEO's outlook about what their business could be and what their spending could be. And why is that happening? Possibly because Fed has not started cutting the rate. They are not confident on starting their capex cycle at the peak of the rate cycle, and hence possibly waiting for the indication from the Fed. And that's why we think once Fed starts cutting rate, there could be a catch up on the capex side, and hence there potentially could be a buildup of the pent-up demand into the system, which may start coming out towards the end of this year or possibly early calendar year. And once those conversations starts happening, there could be a potential of revision of these guidance as well upward.
You said a few companies might raise their guidance. Which ones and which are your bets, preferred picks in the IT sector?
So our preferred pick is Infosys. The guidance what currently is given anyways does not include the acquisition. So once that gets built into, anyways the guidance will have to go up on an overall basis. But more importantly, the expectation is set quite low, 1 to 3% with multiple mega deals ramping up. From that perspective itself, there is a potential for Infosys to raise guidance. It's not something which we are building or we are expecting right now. But if one have to identify a company where there is more upside potential, upside risk, it would definitely be Infosys. And that's also our top pick.
Right, Rakesh, thanks a lot for joining in and sharing with us your views on how the IT sector is likely to perform in the first quarter of FY25. Remember, earnings season begins on Thursday with TCS followed by HCL Tech on Friday. But time for a wrap on this edition of Trading Hour from Rima, me and the team that put this show together. Thank you so much for watching. Halftime report up next.